In 2008, the S&P 500 dropped by 37% in a single year. Investors who stayed in the market, the ones who did nothing, recovered fully by 2012. The ones who sold and time re-entry, some have never caught up. This wasn't about intelligence or access. Both groups had the same information. Long-term investing doesn't reward being smart. It rewards being still when everything else in you screams to move. The hardest part of investing isn't knowing what to do, it's knowing when not to. Many investors already know the basics: to diversify, to think long term, and to keep costs low. The gap is not knowledge, it's how they behave under stress. There's a concept in behavioral economics called the knowing-doing gap. Stanford found that in high-stakes environments, knowledge alone explains almost none of the variation in performance. What matters the most is whether you can execute what you know when conditions deteriorate. In investing, that gap is everything. Because the moment when doing nothing is the most important is also when it feels the most wrong. This is something I explore formally in my quantitative work by looking at the behavioral variance in investor outcomes. Markets don't reward intelligence in isolation. They reward behavior that stays intact when conditions change. As humans, we have been conditioned to believe that effort equals activity, checking, adjusting, reacting. But in investing, effort often looks like resisting. Restraint can show itself as not checking every move, not responding to noise, and not turning discomfort into action. In investing, effort is what you don't do. Relying on that alone is almost a sure way to fail. There's something psychologists call ego depletion, the idea that willpower is finite. But here's the paradox. Investors who struggle the most with restraints are often the ones who rely on willpower to begin with. Restraint isn't about resisting temptation every day, but designing a system that protects you so that temptation doesn't reach you in the first place. That's why you don't have to track your portfolio every day, not because you have extraordinary discipline, but because you have removed the moments where discipline would be required. In my previous videos, I talk about the Ulysses contract, the idea that you bind yourself to a strategy before emotions arrive. That's exactly what long-term investing requires. You're not making one decision at a time. You're making a decision about all your future decisions. Here's what the contract includes. You accept years where it seems like nothing is happening. You tolerate drawdowns in the market and the portfolio without requiring deep explanation. You trust the decisions that you made in advance because they were made when you were calm. When most people start investing, they think that they're signing up for compounding returns, but they're actually signing up for compounding discomfort. I learned this the hard way in 2016. I had a thesis, I had data, I had the conviction, and then I watched my positions drop to minus 30%. I sold at the bottom, not because my analysis or my thesis had changed, but because the discomfort had become unbearable. The position recovered 6 months later, and that's when I realized the edge wasn't more or better research. It was about building a system where I couldn't make that mistake again. So why do many capable people fail when it comes to investing? As high performers, we are used to simple equations. In most professions, law, medicine, engineering, effort equals outcome. Intervention equals improvement. But in investing, markets are a complex adaptive system where high effort often leads to overfitting or just chasing noise. So for most capable professionals, investing actually breaks that feedback loop that we have been conditioned to use in our careers. Charles Ellis wrote about this in Winning the Loser's Game when he compared investing to amateur tennis. In amateur tennis, points aren't won, they're lost through forced errors. By just keeping the ball in play, you eventually rely on the fact that your opponent will make a mistake. When investing, high performers end up failing because they try to win the point with effort, when the system really just rewards keeping the ball in play over a long period of time. In behavioral psychology is phenomena called effort justification. In the 1950s, Leon Festinger found that when we work hard for something, we value it more even when the effort was counterproductive. Nowadays, it's just called the IKEA effect, where people feel more invested in furniture because they were part of helping to build it. He also found that people who went through an initiation process with a group valued the group more, even when they objectively knew that the group was mediocre. We see this in investing, where it shows up as people over trading to justify monitoring their time, or holding on to losing positions too long because you put in so much research to find them in the first place, and just simply mistaking activity for progress. I've modeled this in a lot of portfolio simulations, and the drag compounds a lot faster than you think. Counter to everything that has rewarded you in your professional career, the investors who do the best aren't the ones that work the hardest. They're the ones who have accepted that this is a rare domain where effort and outcome has been decoupled. Here's the real filter. The question isn't whether long-term investing works. We have seen the data and we know that markets deliver over a long period of time. The question is rather whether you are psychologically suited for it. Are you comfortable with what it asks from you? This isn't about intelligence, it's about your tolerance for emotional ambiguity. Ask yourself these questions. Can I go months without any feedback about whether I'm winning? Can I watch a position drop 20% and do nothing? Can I tolerate boredom when I feel others are getting rich quickly? If the answer is no to any of these, it doesn't mean that you're a bad investor. It just means you have to think about the style that fits for you. Being honest and recognizing that is probably more valuable than pretending that it will. The worst outcome isn't to avoid long-term investing entirely. It's starting and committing to it and then sabotaging it halfway through because the emotional cost was higher than you expected. Long-term investing isn't about discipline in the moment. It's about designing a system that means you don't need discipline at all. Warren Buffett says, the stock market is a device that transfers wealth from the impatient to the patient. Patience isn't a personality trait, it's a design choice. If you've built that system, let it run. If you haven't yet, that's the only work that matters.